In corporate finance, every major decision rests on a single mathematical concept: present value analysis. It is the formula used to figure out exactly what a future sum of money is worth today. Fibonacci documented this method in a practical merchant manual 8 centuries before it became the standard of modern Wall Street. To understand its birth, we have to look back to the 13th century. While the Mongol Empire in China operated a unified state with a standardized national paper currency, Europe was a mess of competing jurisdictions. The Italian peninsula alone was a patchwork of hyper-fragmented city-states. Places like Pisa, Genoa, Venice, and Florence were locked in intense, endless rivalries. Their primary state of existence was constant warfare, fighting for control of the lucrative trade routes flowing from the eastern Mediterranean. Funding these wars required massive amounts of capital. The desperate need to pay for fleets and mercenary armies created a market for mathematical knowledge. Out of this violent fragmentation, the machinery of modern global finance began to take shape. Geopolitical pressure builds armies, but it also forces societies to invent entirely new ways to move, measure, and multiply wealth. For a medieval merchant, everyday business was a logistical nightmare. Sailing just a few hundred miles down the coast meant navigating dozens of local currencies and bizarre localized systems of weights and measures. The actual wealth in a merchant's hand varied wildly based on the silver and gold content of localized coins. You couldn't just trust a face value. You had to calculate the metallurgical purity of the money itself. To do these high-stakes conversions, European traders relied on Roman numerals, physical abacuses, or complex systems of finger counting. These methods were slow and limited the speed at which a merchant could settle a contract. The solution arrived with Leonardo of Pisa, known as Fibonacci. He was the son of a Pisan customs official stationed in North Africa, working in bustling trade hubs like the port of Algiers. Immersed in this cross-cultural environment, Fibonacci's father had him trained by Arab scholars. They taught him the Indian method of calculation, what we now call Arabic numerals. Fibonacci saw that replacing Roman numerals with this 9-digit system made it possible to coordinate and systematically scale international trade at a level the Mediterranean had never seen before. Fibonacci returned to the Republic of Pisa and, in 1202, published his masterwork, Liber Abaci, or the Book of Calculation. While the book is famous today for generating a sequence of numbers from a problem about breeding rabbits, it was written as a hardcore, practical manual for merchant accounting. Using the rule of 3, Fibonacci applied fractions to solve complex commodity swaps, like pricing peas and cloth in Syrian Damask. Applied to money, merchants rapidly calculated conversions to exploit market mispricings before abacus-using rivals could finish. This applied mathematics gave Italian merchants a quantitative edge. They could negotiate faster and execute Mediterranean trades with a precision their competitors couldn't match. In Chapter 12, Fibonacci tackles the commenda. These were early corporate partnerships, where one partner provided the capital and the other provided the labor and assumed the physical risk of the sea voyage. Dividing profits was rarely simple, as partners often contributed capital at different points in time. Fibonacci used algebra to determine a fair split based on the exact duration of each investment. He pushed this logic further with scenarios like the soldier's annuity and the traveling merchant. These problems required calculating the exact value of a future payment if paid out today. This timeline shows how he solved it. Fibonacci created a framework to discount future cash flows, reducing a series of payouts spread across years back into a single concrete number at the starting date. By mathematically discounting those future cash flows, Fibonacci provided the framework for present value. For the first time, a merchant could put an exact price on the passage of time. This math immediately collided with medieval law. The church strictly banned usury, the charging of interest, which made traditional credit markets across Europe difficult to navigate. Merchants used Fibonacci's math to create bills of exchange. These documents allowed for long-distance transfers, but by embedding the interest rate directly into the currency exchange rate over time, they could legally bypass the church's ban. Once city-states could quantify future value, they began to borrow against their own future tax revenues. They invented the long-term government bond. These bonds provided the massive liquidity needed to fund regional conflicts and hire famous mercenary commanders like Sir John Hawkwood to lead their armies. This financial engineering shifted the balance of power. It created a merchant financial oligarchy that began to eclipse the influence of the traditional land-owning nobility. This brings us to the Needham puzzle, the question of why Europe eventually overtook China economically, despite China's earlier technological and political advantages. Historians often point to the different pressures these systems faced. While China's unified system was stable, the constant friction of the Mediterranean forced Italian merchants to adopt complex financial tools just to survive the competition. This mathematical foundation allowed Western companies to borrow, raise equity, and accurately price risk. It provided the infrastructure to project commercial power across the globe. Today, a full-length marble statue of Leonardo Fibonacci stands in his home city of Pisa. His famous number sequence describes the growth patterns of nature, but the math he brought to the Mediterranean did something else entirely. It provided the mathematical DNA used to turn time into money.